Hey guys, James here with Waterford Business Solutions. And as we wind down to the end of the year, it's already December, and I honestly can't really believe that. But as we get here towards the end, there's a lot of excitement as we go through Thanksgiving that we've just gone through, Christmas coming up in a few weeks, New Year's, all the parties, all that joy, fun, etc., going on over the next few weeks. It's a ton of fun, but once all of that wears off and we get kind of into the second, third week of January, then we end up in kind of the lull of the year. Everyone's kind of a little bit humglum. It's cold, it's dark, it's winter, but worst of all, it's tax season. That's rapidly approaching. Tax season generally opens up at the end of January. It's something that we start working with clients as we get here into December working on so that when we get into January, it's a quick, seamless, easy process. But the big thing that we run into a lot of times with tax season is understanding all the different lingo and all the different information. And what is something we wanted to focus on is the difference between a tax deduction versus a tax credit. That's something that comes up all the time, and people confuse them a lot. And so we wanted to kind of take some time this week to define exactly what those two things are. Before we jump in here, I do invite you to go ahead. With tax season coming up, there's going to be a lot of information going out. We plan to put in a ton of work over the next few weeks here, getting you a bunch of information here in January, February about taxes to arm you with as much as possible here. So go ahead and like and subscribe to our channel here. Turn on notifications. We put out videos every single Monday for this reason. And join us on this tax journey so that you guys can get ahead of this curve going forward. Now, getting into deductions versus credits. A deduction is fairly simple as long as there is some reasonable cause for deducting it. So we work a lot with business owners. As long as there's a reasonable cause for that expense, that could be considered a tax deduction. So if you are a plumber and you're buying materials, you've got labor, you've got subcontractors, advertising, anything and everything like that, that all falls under a tax deduction. Same thing works for HVAC, electrical, anything that you would use in your business can be called a tax deduction pretty easily. Now, let's be cautious when we're saying anything you can use in your business can be used. There are some fringe things, and I've had clients try to do certain things here. Just because the business paid for it doesn't make it a tax deduction. I've had clients in the past who end up using the company credit card to buy mattresses, to buy toys for the kids, to buy clothes and different things like that. And they come to me and say, oh no, that's a tax deduction, or that's an expense that I want to put on the books. And we have to have the discussion of, well, in the event of an audit, how are you planning to defend this? Because how does a plumber need a mattress to run his business? How does a plumber need a trip to Disney to run his business? How does an HVAC contractor need a speedboat to run his business? It's all things that I've seen. So just because the business spends the money doesn't mean it's a tax deduction. So let's start with that. Beyond that, while the business has deductions, there are deductions that you as an individual could take. If you've got mortgage interest that you're paying, if you've got state and local income taxes that you're paying, if you've got, depending on how much income you have, out of pocket, not something that the insurance companies are covering, but out of pocket, medical, hospital expenses, anything and everything like that, you may be able to deduct those. Charitable contributions, you may be able to deduct. If we can add those categories together and exceed what the standard deduction would be for you as either a single filer or a married filer, then you could technically start taking deductions on those expenses rather than getting a $14,000 standard deduction as a single filer, over a $29,000, $30,000 deduction as a married filer, because those are the standard deductions. I've got clients that, due to the charitable contributions they have, or due to taxes that they have, or the mortgage they have, we're able to get $50,000, $60,000, $70,000 in personal deductions in addition to whatever the business is doing too, and that helps to reduce your tax liability. Now, the important thing to keep in mind here is a deduction reduces your income. Repeat that again. A deduction reduces your income. Your taxes are based off of your income. So we take a look at the end of the day and we say, hey, this is the income that we have. These are the deductions we have. This is the income net, any deductions that we have. And then we use that net income after all the deductions to figure out your tax liability. So if you're in the 22% bracket, then we're going to bracket up in the income taxes for whatever that net income is there, and that's what you're paying. A deduction is not a one-for-one reduction in your tax liability. Because just because you spent $100 doesn't mean that you had $100 in tax savings. If you're in the 22% tax bracket and you're squarely in that bracket, spending that $100 to deduct that $100 only saves you about $22 in income taxes. So a lot of people are like, oh, I'll just spend the money, I can deduct it, I won't pay taxes on it. No, you won't pay taxes off of the percentage of whatever your tax bracket is, both federal and state. Keep that in mind. If you're in a state that has state income taxes, you'll have state taxes to pay on that net income after all deductions. So just because you spend the money does not mean that you won't pay taxes on it with a tax deduction. All a tax deduction is a reduction in your taxable income. Just one more time there. So many people get that confused, and while it seems like a fairly basic concept, every year I'm going to have at least 2 handfuls of clients come to me and say, well, I spent this much money, why do I still owe this much in taxes? Because just because you spent that, you still have this income left over. Now, the difference, or the other side of that, is going to be a tax credit. A tax credit is something that you earn, and that's a credit against the taxes you owe. So a deduction is a reduction in your taxable income. A credit is a credit against taxes owed. So there's many reasons you could get those credits. In years past, you could get them for energy efficient home improvements, windows, HVAC units. That's all phasing out like we've talked about here kind of towards the end of December. We talked about that a few months ago. But we also have other credits for starting 401ks. If you're an employer and you're hiring people coming out of jail, people who've been unemployed, hiring military veterans, there's work opportunity credits that exist there. There's a lot of different credits, R&D credits, etc., that exist out there. And those credits are a one-for-one reduction on your taxes and your tax liability, rather than just being a reduction in your taxable income. Now, credits are a lot harder to come by. There's only so many credits that are out there. There's generally a lot of loopholes that you've got to jump through, a lot of paperwork that you've got to do to claim these credits, because it is a really good benefit at the end of the day. I mean, there's people that get $10,000+ in credits from hiring people, and from doing research and development credits, and from doing 401k things, etc. So there is going to be more requirements here. But if you owe $50,000 in taxes and you've got a $10,000 tax credit, now all of a sudden you only owe $40,000 in taxes. Whereas with a tax deduction, if you owed $50,000 in taxes and you spent $10,000, you may only be getting a $1,000 to $3,500 reduction in that tax number, even though you spent that $10,000. So the difference between a deduction and a credit really boils down to reduction in taxable income and a slight reduction in taxes versus a reduction in the taxes that you owe with a credit. As always, guys, thanks so much for joining us here. If you are worried that you're not ready for tax season or don't have someone to help you with taxes, please feel free to reach out to us here at Waterford Business Solutions. Give us a call at 864-351-0852 or shoot us an email at info@waterfordbusiness.com. We're happy to help you out, happy to tell you where you kind of stand, point out any issues that we have. We generally do free tax reviews and consults on initial calls there, so that's perfectly fine if you want to reach out to us there and get a baseline understanding. And until the end of the year here, and it'll end on December 31st, but until the end of the year, we are offering discounts on our tax filing services if you go ahead and reach out to us now. Also, if you, like I said at the beginning, want to stay on top of all the upcoming tax stuff and just overall become a better master of your business's finances, feel free to give us a call here. Feel free to subscribe to our channel, like this video, share it with anyone that you think could use this information. Until next week, have a wonderful rest of your day.